Hello everyone, welcome back. This is Valery Nikolaev, and in this video we'll talk about cash flow statement and its mechanics, basically how it is constructed. We'll talk about direct method and indirect method. Okay, the idea behind cash flow statement is very simple. It basically tells us about reasons for why cash balance increased or decreased over a given period of time, right? What are the reasons for why cash is changing over a period? Unlike balance sheet, which is at the point in time, it's over a period of time, of course. Okay, so it answers questions such as, did company generate enough cash to finance its own operations, or did it require injections of cash, for instance, by raising capital outside in the form of equity or in the form of debt, or whether cash was generated perhaps by selling some of the assets to finance operations and so on, right? It answers questions like whether company has or is generating enough cash every period to cover some of the obligations, to pay interest, for instance, required on their liabilities, also to be able to cover some of the current obligations that will come up within 1 year from the current date, right? Cash flow statement is also useful to understand whether the company made some important investments, how much did it spend on capital expenditures, did it acquire some other companies, did it divest a part of their business in a given period, right? So this is all types of questions that cash flow statement is going to be useful for. Finally, something that many people don't appreciate, but that's also an important reason for why cash flow statement is useful, is that it allows us to understand precisely what drives the differences between cash that operations are generating and earnings that company reports, right? Earnings are reported on accrual basis. Cash being generated by operations, by definition, is cash kind of basis. And so the two can be quite different, and it's useful to understand why, because that can tell you a lot about the economics of the firm. Is it growing? Is it contracting? Is it experiencing some issues with operations? Or, are things looking very normal as they should? Okay, so that's why cash flow statement is going to be useful. Now, having said this, while cash flow statement is very intuitive, if you think about it, it is much less intuitive when it comes to constructing cash flow statement and understanding some of the adjustments on the cash flow statement that you are going to see, right? So we will work on that. This is something where you can actually develop an edge over many other users of financial statements, because most people are comfortable reading balance sheet and income statement, but relatively few people understand what's going on in the cash flow statement. Okay, so after listening to these videos, you will have a much better sense what's going on. Okay, so let's first talk about the basic structure of the cash flow statement, right? Cash flow statement has 3 sections: investing activities, financing activities, and operating activities. And so there are 3 types of cash flows, right? Cash flow from investing activities is cash flow related to investing transactions, right? So these are acquisitions of property, acquisitions of equipment, basically acquisitions of long-term assets, or their disposals, okay? Also, this includes acquisitions of securities, like marketable securities, that are not intended for active trading, okay? And so this is investing activities, quite intuitive. Financing activities are transactions with capital providers, right? With shareholders, with creditors, these involve issuance or repayment of debt, issuance of equity, payment of dividends, and maybe something of this sort. Okay, so these are the financing activities, and operating activities are defined as all other transactions, right? No, of course, operating activities are going to be transactions that happen on a day-to-day basis, such as buying inventory, collecting accounts receivable, paying salaries to your employees, paying taxes, and so on, right? Paying interest, right? So it's important to emphasize that actually interest that you pay or receive, right? If you give a loan to someone, you're going to receive interest. If you borrow money, you're going to pay interest, right? So under US GAAP, interest that you pay or receive is going to be classified as operating cash flow. Now this is where sort of the boundary between some of these classes of cash flows are not crystal clear, right? And this is just how it is. It's kind of very difficult to sort of take a real life issue and put it very sharply in one bucket or the other, right? Because interest is something, right? When you pay interest to creditors, it's kind of a transaction with capital providers, but at the same time, interest is an expense item in your income statement, right? And you kind of need to pay interest to operate, right? You need to kind of borrow and compensate creditors in order to continue operating day-to-day activities. And so from that standpoint, it's included in the results of operations, and as a result, it makes sense to think about it as operating cash flow. So for this reason, we kind of need to pick a stand whether we think about it as whether we classify it as a financing or operating. Under US GAAP, interest is classified as operating activities. Okay, now IFRS or International GAAP basically it gives companies an option to classify interest as operating activity or financing activity, as long as company clearly discloses what they do. Okay, it's also important to know that dividends that you receive is classified as operating activity, whereas dividends that you pay to your shareholders is classified as financing activity. Okay, so these are just things to kind of remember. The sum of the three types of cash flows give you total cash flow, which is equal to total change in cash account over a period of time. Okay, so there are two ways how cash flow statement can be presented and how it can be constructed: direct method and indirect method. Direct method is much more intuitive, but is actually very uncommon. For some reason, companies don't really use that all that much. Whereas indirect method is something that 99% of companies report. Okay, so direct method works as follows. Basically, you see cash flows by source and use, right? So for instance, what are the sources of cash flows? Cash received from customers, for instance, cash received from for example, capital providers if you raised capital and so on. Whereas cash outflows include cash such as cash paid to your suppliers, cash paid to your employees, cash paid to tax authorities, cash paid in the form of interest, and so on, right? So this is direct method. Cash flows are listed by type and whether it's inflow or outflow. Okay, indirect method works by basically taking net income and doing a bunch of adjustments to basically take away all the accrual components from net income, because we measure income on an accrual basis, so that what's remaining in the bottom is basically cash-based income or operating cash flow, essentially. Okay, now this distinction between direct and indirect is only relevant for operating section of the cash flow statement. Investing and financing section of the cash flow statement always follow direct method, right? They always say cash flows by type, and for instance, cash spent on buying property, plant, equipment, and so on. Okay, so here's an example of cash flow using indirect method, right? So we have net income over here, and basically we have adjustments to net income listed next to it, and then in the bottom we have cash flow from operating activities. Okay, so that's indirect method cash flow statement. Now, direct method cash flow statement is a little bit harder to find, so this is an example that dates back some time, but basically you get the idea, right? So we're going to have sources of cash and uses of cash, and this includes basically cash received from customers, collections of billings and so on, cash paid to employees and suppliers, interest, taxes, and so on. Okay, so this is the direct method cash flow statement. Of course, the result, the total operating cash flow, is going to be the same irrespective of which method is used. That's important to realize. Okay, so the most important to understand for you to get a good sense and grip on the cash flow statement is the mechanics behind its construction, right? So once you become comfortable with mechanics, you can start building up intuition, and that's basically the best way to learn it, right? And mechanics is quite simple once you kind of see how it works, right? So basically we have a balance sheet equation over here, right? And of course we can take this balance sheet equation and write it as cash plus non-cash assets equal liabilities plus shareholders' equity. Okay, and then we basically can take this equation in the end of the period and subtract the same equation from it as of the beginning of the period, so that we have changes. Changes in cash plus changes in non-cash assets equal changes in liabilities plus changes in shareholders' equity, right? Of course, that has to hold as well, because balance sheet holds. And so then all we need to do is basically rearrange this equation in this form, change in cash equals change in liabilities plus change in shareholders' equity minus change in non-cash assets. Right, so this gives you a very good idea of what's going on in the cash flow statement. Basically, accountants are trying to determine cash flows and explain change in cash over a period of time by looking at changes in non-cash accounts. It sort of sounds a bit counterintuitive, but this is how things work. I mean, more intuitive way would be actually to have each transaction that debits or credits cash classified into, one of the three types of cash flows. This is not what accountants do for various reasons. It wouldn't be necessarily very practical. So a more practical thing to do is basically, to do this, which is explain change in cash by looking at changes in non-cash accounts. Okay, and so this equation basically helps us to think about increases or decreases in assets or liabilities in terms of consumption or source of cash, right? So for instance, let's take non-cash assets, right? When non-cash assets increase, we think about it as a consumption of cash, right? Why is it? Well, think about non-cash assets going up because we have minus sign over here. This side of the equation is going down, right? So that's why increase in non-cash assets is thought of as consumption of cash, right? And it's intuitive. For instance, when you buy inventory, inventory goes up, which is an asset, non-cash assets go up, and cash, of course, is going down, right? So this equation holds in the way it should, right? If non-cash assets decrease, we think about it as a source of cash. Think about accounts receivable going down. We are collecting cash, right? So that's basically how we think about increase or reduction in non-cash assets, right? You can think about sort of having total amount of assets over here, and these are non-cash assets. So as non-cash assets go up, cash is sort of squeezed, whereas if they go down, cash increases, and that's a source of cash. Okay, the opposite is true for liabilities and shareholders' equity accounts, right? When liabilities go up, such as, say, loans or accounts payable, that's a source of cash. When shareholders' equity goes up, like contributed capital, that's a source of cash. Whereas when when liabilities or shareholders' equity go down, think about dividends being paid out of retained earnings, or distributed out of retained earnings, or accounts payable being paid off. That's of course a consumption of cash, right? And so basically this 2x2 matrix is something you have to keep in mind, at least in the beginning. And of course, what's going on in this matrix is perfectly in line with the equation that we have seen previously. Okay, so this slide gives you a little bit more detailed breakdown of this equation, right? So of course, we take this equation over here that we just saw. We can think about changing liabilities in terms of current and non-current liabilities, and same for assets in terms of current and non-current liabilities. And then non-current, and of course shareholders' equity is going to be basically change in contributed capital and retained earnings, right? And we further can classify retained earnings into two components, which is net income minus dividends, and change in non-cash assets, change in non-current assets, which is basically property, plant, and equipment, happens because we buy assets. At that time, these assets go up, and then subsequently we depreciate them. That's why they go down, right? So this is another sort of breakdown of change in non-current assets. All these variables are defined over here, so you can kind of review this a little bit later, take a moment to understand it, because this is quite useful. But the basic idea is that we have now our equation written in a little bit more detailed form. And then we take each of these changes and classify them as to whether it's related to operating activity, financing activity, or investing activity. Right? So for instance, if we take change in current liabilities or change in current assets, those are classified as operating transactions, right? Current liabilities and current assets change due to things like, buying inventory, receiving accounts receivable, paying accounts payable. Those changes are related to operating day-to-day transactions, okay? Then we have things like non-current liabilities. That's going to be because we issue or repay debt. Right? So that's going to be a financing transaction. We also have things like changes in contributed capital because we issue capital or return capital to shareholders, right? So that's going to be a financing transaction. Then change in retained earnings consists of earnings and dividends. Dividends, of course, a financing transaction. And change in non-current assets consists of capex and depreciation. Capex, capital expenditures, is investing activity. Okay, so what we have is left here is net income, which is ultimate operating cash flow, right? We think about net income measuring on accrual basis, not how much cash we currently receive, but what is the amount of cash operations generate ultimately from transactions in the current period. So intuitively, net income has to do with our operating activities. And of course, then we have depreciation, which is classified as operating transaction. It's a little bit special, depreciation adjustment, and we will get more comfortable with what's going on behind depreciation as we work through some examples, right? But basically, because net income contains non-cash item, which is called depreciation expense, that item is subtracted from net income when we calculate it, and depreciation over here, which is the change in accumulated depreciation, is going to adjust for that, and so that we cancel the two items out. Okay, so what we have here is basically cash flow from financing activities equals, cash flow from operating activities equals to changes in current assets and current liabilities plus depreciation plus net income, right? Then we have investing cash flow, which is basically the amount of time you spend, the amount of money you spend on capital expenditures, and then you have financing cash flow as well. It's important to kind of keep in mind of this formula in the bottom, which basically tells us, it draws the parallel between cash flow from operations and earnings that the company generates, right? So it says cash flow from operations equal to earnings before depreciation, right? So if we take this, then this is going to be earnings before depreciation. That's how you can think about it. You basically take earnings and add back depreciation. That gives you pre-depreciation earnings. And then you subtract changes in working capital accruals, right? These are changes in inventory, receivables, and payables, pretty much, right? I mean, maybe some other things as well. Okay, so now if we think about it in terms of a longer time span, you will realize that all our accrual accounts, right, which are accrued revenue, accrued expense, deferred revenue, deferred expense, right? These are basically receivables and payables and so on, right? Those accruals, they live for a very short period of time. Well, I mean, relatively short period of time, like typically a year, for example, and then they reverse. Remember, like when accounts receivable are debited, they go up, say by 100, but in the next period they're collected and they go down by 100. What that means is that over time, changes in working capital, they go to kind of zero, they reverse. So if we accumulate cash flow over 5, 10, 15 years, working capital sort of collapses and adds up to relatively small amount, right? Whereas net income before depreciation, it accumulates. And so what this means is that cash flow from operations over a long period of time sums up to earnings before depreciation. Okay, that's kind of conceptually important to understand. And yeah, accruals basically reverse. So it's something to think about. I mean, basically this says that over a long period of time, accruals do not matter. Whether we measure earnings on cash basis or accrual basis over a long period of time is not really going to matter, because accruals kind of, what accruals do, they kind of they shift cash flows from, you know, one period to another, right? And so that they recognize in the income statement. And as we extend the time period, this shifting kind of doesn't matter. You know, the cumulative cash flow and cumulative earnings are going to be the same. Okay, and the last thing to talk about is the notion of free cash flow, right? Free cash flow is basically something that you will use quite a bit, especially if you do financial modeling, valuation of firms, and so on, right? So it's typically defined as discretionary cash flow that management can use for whatever purpose they want, right? To pay dividends, which is optional, of course, to repay some of the debt if they would like, to make investments, and so on. Okay, so free cash flow can be defined in many sort of ways, with number of adjustments and so on, but the most basic definition that we start with is basically free cash flow equals the difference between operating cash flow and capital expenditures. Okay, and of course we know that operating cash flow is net income before depreciation less change in working capital accruals, so we only add here capex, right? That's basically how you can kind of think about cash flow, free cash flow. So you will notice that free cash flow, right? I mean, this is nothing else but change in non-cash, non-current assets, which is over here, right? So free cash flow basically is equal to net income minus changes in non-current assets, and then minus changes in current assets and liabilities, right? So if we take very long perspective, right, 20 or 30 years, change in non-cash assets is going to also go to zero, just like change in working capital goes to zero, because accruals reverse, right? Working capital accruals, they reverse over a short period of time. Non-working capital, non-current accruals reverse, like property, plant, and equipment, reverse over, you know, 20, 30 years, over the life of the equipment, basically, right? When we buy equipment, property, plant, equipment goes up, but then over 20 years, it goes down to zero through depreciation, right? And so over 20 years, if we basically aggregate all changes on non-current asset accounts, they will kind of converge to zero, something close to that, right? Over the life of the firm, at least. Okay, and so that means that another conceptually important point is that free cash flow has this parallel or correspondence with net income, right? So if you measure net income over a long period of time, and if you measure cash flow, that's free cash flow over a long period of time, those are going to be converging, because all accruals, they're washing out. They kind of only matter of when we're trying to slice performance into relatively short periods, right? If we measure performance over the life of the firm, which is like 30 years or 50 years, then all this accrual accounting do not matter. Of course, investors don't want to wait for 50 years to measure how well the firm did. They want information that's timely. Every period they want to know something about profitability and so on. And that's why accrual-based performance is going to be quite useful. Okay, but this is something that's important to understand about free cash flow. In the next videos, we will walk through the exact construction of the cash flow statement using indirect method and then subsequently direct method. So that's all for this video. Thanks very much.